What's up, guys? Welcome to Distort the Order, a place where you will find no lies. Now, you can surf on YouTube and find a plethora of videos from different YouTubers who want to give you their 2 cents on the market. Pretty much every video out there is stating the same thing. Debt is at an all-time high. Certain sectors like airlines, hotels, retail, financial, automobile sectors are in a lot of trouble. And they'll all refer to Warren Buffett and what he's doing and how he's mostly been selling a bunch of stock in some major sectors himself. While I love Warren Buffett and his investment strategies, these videos are going out and telling you that the market is grim. And really, these videos reach no conclusion other than we're expecting a huge downturn. And while that may be true, and it does mean to be prepared and maybe sell a bit of stock, these investors are literally giving you the false conclusion that there are no good companies to invest in, and that's just straight up wrong. So today, we're going to do an analysis on different economic sectors, evaluate what the effects on these sectors are, and we're going to learn that there are some sectors that will be just fine, and some that'll even do well. Before I start, I'd like to ask you guys to like, subscribe, comment, and hit the notification bell on the video so I can keep releasing good content for you guys. Now, as a disclaimer, I want you guys to know that I am not giving you financial advice. I am showing you companies I personally like, and it's your job to do your own research. And I could be wrong. I just doubt it. Let's get into it. Now, the easiest way I can describe investing in stock is like this. If you're buying a company stock, you are buying that business. So if you buy Apple stock, for example, you own Apple and you are an owner of a piece of that business. So our job is to assess which publicly traded businesses are going to do well during a recession and which companies will struggle or flat out get obliterated. We all know the recession is coming, so the companies you want to be investing in are businesses that won't be affected, or at least affected insignificantly at a time like this. The purpose is not to maximize your return, but to minimize your risk and get an attractive expected return at that risk level. So first, let's start with the sectors that are about to get destroyed and have already seen stock price decimation. Like I said earlier, airlines, hotels, retail, restaurant, financial, automobile, and oil. These are enormous sectors. Now, to summarize in a nutshell as to why these sectors are not attractive and will not be attractive is because they are capitally intensive businesses. And what that means is that they need to invest a lot of money, whether it be in staff, equipment, property, manufacturing, and the financial sectors loan money to all these sectors so that they can make money. So in summary, these companies need to invest $100 just to make $10 of profit. What that means is that for these companies, a pandemic and things being shut down for a couple of months means risking bankruptcy, laying off workers, and this company still has to pay extremely high expenses like rent. And for the automotive industry, the car's value that they manufacture is depreciating while there are no sales on the lot. And they have tons of overhead with all their machinery and equipment. And they got to repay off all the loans for the money that they borrowed to get these businesses running while having very little sales. To me, this is the biggest risk in not just the economy, but the stock market overall. I think that this itself could be a catalyst for a downturn in the next year or so. Now, a lot of the unemployment seen in the world are businesses in the sectors like these. And I want to personally stay away from all of them when it comes to investing my money. I stay away from them in general because I like more financially efficient companies. But especially right now, I will never buy a stock of these companies, even if they have already taken a huge hit. Now that we got what we don't like out of the way, let's talk about some businesses that make money no matter what. And not just that, they make money more efficiently than the above mentioned companies without the need of so many expenses. And these companies have little debt, and so they will be able to weather this economic storm going on around in the world. In the last 10 years, we have seen a huge shift towards the internet to do virtually everything you would ever want to do. You can stay in touch with people, you can play video games, you can buy stuff, have it delivered to you within days. The awesome thing about internet companies is that they don't need to invest in the complex system of the companies I mentioned earlier. They don't need to manufacture a bunch of vehicles. They don't need to buy tons of physical property. They don't need to invest in machinery and equipment and tons of staff to get the ball rolling. They just have a platform and they make money off that platform. Companies I would buy at the right price that follow this criteria are Facebook and Google. These two companies make money from advertising on their platform. So if someone wants to advertise for their e-commerce, they will go to Facebook or Google for YouTube, and they will post videos or post ads or pay for ads. And this is how these companies make money. Because they make money like this, they don't have tons of overhead. So the money that they make from advertising actually makes them a lot of net profit. And so while advertising revenue might decrease in the short term, in the next year or two, they don't have tons of overhead and debt that will decimate their stock price. They actually have tons of cash. They have a good, sound business model, and they'll be just fine. Now, I love Facebook. Facebook is a great company, especially during a recession. They have virtually no debt. All they have is cash in the bank. They make crazy profit margins. They have very little expenses, and they make money just for being Facebook, in that people pay Facebook to advertise on their platform. Facebook doesn't have to innovate as much as other companies. They don't have crazy expenses, and they make a lot of profit for just being alive. They also own Instagram, WhatsApp, and they're now coming up with Facebook Shop, which maybe will compete with Amazon. There is always tons of potential with Facebook as a platform, and it's an excellent business model. The only thing I don't like about Facebook at the moment is the high multiple. I think they're a bit expensive, but money spent in this company is rarely a bad move in the long run because this business model is so damn sexy. Two companies that are similar to that business model are Visa and MasterCard. And you would think, hey, how is Visa and MasterCard similar to Facebook? Let's get into that. Visa and MasterCard make money in the easiest way possible. All that has to happen is someone pulls out a Visa or a MasterCard and buys something with it, and Visa will immediately get a cut of that transaction. They don't even have to hold credit card debt. The banks hold that. So they just get a small processing fee, which in the context of the entire world is a lot. These two companies have the highest profit margins out of any companies that are publicly traded. And I would go out to say that they make the most profit out of any company in the world if you look at percentages. But again, these companies are trading at pretty high multiples, and I do think there will be some downside in the near future. But again, these companies are not going anywhere. Your investment will have a lot of value, and they don't have a lot of debt. They make the best margins in any company in the world, and they are platforms, meaning they get paid just for existing. If you also consider that Visa and MasterCard are making cryptocurrency moves, you silly crypto junkies should take a look at an actual company that is making cryptocurrency rather than trading dumbass cryptos. Now, while I love these companies and I will be buying these companies, I am not buying them right now because I feel that as of today, May 27th, 2020, they are a bit overvalued. But you can definitely expect that I will buy these companies in the course of my life again, and I constantly look at their prices. Another company I like a lot right now is McDonald's, because McDonald's is recession proof, as you can see with the 2008 collapse. But I feel that there will be a better time to buy in the near future simply because the pandemic caused restaurants to shut down in the short term. So I feel that in the short term, McDonald's stock price could come down for a little bit, and that will be the best time to jump in, because as restaurants open and the economic fallout of the pandemic starts to become more obvious and the recession becomes more felt in our wallets, people will resort to McDonald's. And if you look at the most recent financial collapse in 2008, you will see that McDonald's actually thrived throughout it. With that being said, I just gave you guys a bunch of my favorite companies, and I told you that I'm not buying them right now. So that begs the question, well, what are you buying? So the company I purchased recently is Fox News. Fox News is trading at a very cheap multiple. And if you know anything about Warren Buffett, what I just said would be very interesting to this man. In fact, it is cheaper than the multiple he paid for his biggest move in the last couple of years, which is adding to his huge stake in Apple. Buffett's core investment principles are the following. Buffett looks for companies that provide a good return on equity over many years, particularly when compared to rival companies in the same industry. Fox News makes excellent revenues. They have a 20% net margin. So for every $100 that they earn, 20% of that is profit. And that is very, very good when you compare it to other companies. When looking for a great company to invest in, Buffett also reviews a company's profit margins to ensure they are healthy and growing. Once again, they have very good margins, roughly in the 20% range, which is very healthy. Buffett focuses on companies that provide a unique product or service that gives them a competitive advantage. He also focuses on companies that are undervalued that he can purchase. Fox News fills all the criteria that Buffett goes for when he looks for a potential investment. Now, while Fox News may not have a unique competitive advantage in the newscasting industry, they do have a competitive advantage in the news industry for Republicans. And this is also an election year for a huge election, especially with a controversial figure like President 45. And President 45 is actually the leading current Republican candidate. I think this is a good year to own Fox News, and I will probably be buying more. So that's what I'm buying. Now I want to hear from you. What are you buying, or are you selling? Do you have any thoughts or opinions you want to leave? Leave them in the comment section below. Make sure to subscribe if you like content like this. And I made this video to inspire you guys to not just get locked up in the paranoia of a recession, because I know for myself, I'm a very conservative investor. And at times like this, I hesitate to invest, even if I find a great company at a great price. And that's what I want to prevent for you guys, because the mood of a grim economic outlook can sway you away from excellent opportunities, and it's always healthy to get a good discussion going. Until next time.